Over the last 20 years, the Indian stock market has seen a massive surge in wealth. Yet, the vast majority of retail investors fail to capture those returns in their own portfolios. Think about how you shop in everyday life. If there's a holiday discount, people rush to buy. But in the stock market, investors do the exact opposite. They ignore the discounts and only buy when prices are at their absolute highest point. Instead of looking ahead, many investors drive looking strictly in the rearview mirror. They select their investments purely by chasing yesterday's top-performing funds. Take the recent rush into precious metals. After massive multi-year rallies, investors are suddenly pouring money into gold and silver right as these assets reach their 52-week peaks. Treating the market like a retroactive shopping spree guarantees poor results. Market cycles inevitably turn, and those who buy in after the performance has already happened are the ones left holding the bag. A major reason for this behavior is a core misconception about how finance works. Many people believe investing is a simple arithmetic formula, a predictable machine where you input cash and receive a smooth 15% return every year. The reality is much harsher. Markets move in volatile, unpredictable cycles, delivering severe drawdowns just as often as they deliver highs. Surviving these cycles doesn't require a genius-level IQ. As Warren Buffett famously notes, success in investing requires a specific emotional baseline called temperament. Mastering your own psychological triggers and learning to control fear and greed is the actual requirement for changing your financial destiny. Building true wealth requires deliberately acting against human instinct. You have to walk entirely separate from the crowd. The rule of the contrarian is simple but agonizing to execute. You sell when there is good news and a euphoric market, and you buy when there is terrifying news and a collapsing market. This chart shows the sharp V-shaped drop of the market crash in early 2020. This was a period of peak panic. But with rock-bottom interest rates and asset classes that hadn't generated returns in years, it was a mathematically sound moment to buy. Compare that to the stagnation investors face when they finally buy into an asset class only after it has enjoyed a highly publicized 10-year bull run. The greatest financial opportunities are often hidden inside the very assets that the general public currently hates the most. Of course, perfectly timing these emotional highs and lows is nearly impossible. That is where asset allocation, often managed through hybrid or balanced advantage funds, comes in as a mechanical safeguard. Think of investing like a manual car. You wouldn't use fifth gear in traffic or first gear on an expressway. You must adapt. Asset allocation is your portfolio's automatic gearbox, dynamically shifting capital between equity, debt, and gold based on institutional buying. But there is a vital rule here. Simply buying an asset just because it is failing is a quick way to lose money, unless that decision is backed by disciplined, fundamental research. You have to look under the hood. Examine a company's debt levels, its corporate governance, and its long-term survival odds before committing a single rupee. Proper asset allocation, paired with that rigorous research, removes the emotional burden of market timing entirely from your shoulders. This brings us to the reality of systematic investment plans, or SIPs. There is a massive gap between what investors intend to do and how they actually behave. Retail investors frequently declare they will hold an SIP for 20 years. Yet, at the very first sign of severe market volatility, panic sets in and they abandon their strategy entirely. Furthermore, starting a new SIP right at the absolute peak of a narrow, highly hyped market beam almost guarantees a poor long-term experience. True investment discipline means starting your SIP in a broad category, leaving it alone for decades, and completely tuning out the daily noise of the market. The mathematical advantage of compounding time can do the heavy lifting for you, but only if you have the emotional fortitude to stay in your seat. The market will eventually humble everyone. Surviving those moments requires Kaizen, the philosophy of continuous improvement. Even master fund managers make painful mistakes, like missing major market rallies. Progress comes from analyzing those errors, learning without ego, and refining the process. Investors must stop searching for a perfect, infallible arithmetic formula to beat the market. It doesn't exist. Instead, allocate your assets wisely. Buy what the crowd hates, sell what the crowd loves, and let time work its magic. Long-term financial success is rarely about complex mathematics. Ultimately, it is a byproduct of inner calm